evening, ladies and gentlemen. Good evening, panelists. Today's webinar is brought to you by PMS AIF World, and I am Sankalp Pal. I take care of business development and client relations at PMS AIF World. PMS AIF World is a new age investment services company, and we do two things very well, and that has built us a name. So one of them is wealth management, and the other is content and analytics that we provide to investors, and a part of which today's initiative also is. So we, in our over 2 years of existence, we manage close to 400 crores in asset across 100 families, and and a lot of NRIs also on our platform. So what our philosophy or what our driving force is, we follow a 4P analysis of portfolios before we can recommend our investors. So the first P being the portfolio, the second being the philosophy, the third being the price, and the fourth being the obvious performance. So these 4Ps are our guiding principles. And in accordance with that, today we have a very special guest with us, Mr. Prashant from WhiteOak Capital. And Mr. Prashant has been the ex-CIO of Goldman Sachs Asset Management for emerging markets and India. So he has been, he's the founder of WhiteOak Management, which has been there around since 2017 for 3 years now. And Mr. Prashant's WhiteOak Capital manages close to $1.7 billion in assets. And without much ado, I will hand over the floor to Mr. Prashant so that he can take us through his investment ideas and all about WhiteOak. Thank you, Mr. Prashant, for being with us today.
Thank you, Sankalp, for having us here today, and thank you to PMS AIF for organizing this. And thanks to all participants who've taken the time to join today. I think it's also outcome or byproduct of the kind of world we are living in right now. We all otherwise would be watching an exciting game of IPL at this hour if it was not for the situation we are in. Thanks again. What I would say is start with very, very brief introduction of who we are, but quickly move on to the topic that I've been told for the day, which is the economic and market outlook in the current situation, and then move on to WhiteOak's philosophy and approach, and then open up for Q&A after that. So my colleague Vivek would be sharing along the way some screens here as I move forward. So WhiteOak, as Sankalp said, is about 3 years. Sorry, Sankalp.
Can you, Mr. Prashant, can you just get a little closer to the mic?
Certainly. And I'll speak louder if that's helpful. Is it audible?
Yes, perfect. Thank you.
So WhiteOak is 3 years now. We started in June 2017 after I spent 17 years at Goldman, and prior to that at State Street Global Advisors and whatnot. We have thus far raised about 12,000 crores, 80% or more of which is from outside India, predominantly global institutional investors, sovereign wealth funds, pension plans, and so on. And also family offices from Europe and Asia, as well as the US. We have a team of 12 members on the investment team, very well resourced. I'll talk more about that in a short while. But let me jump in the interest of time quickly to the topic du jour, which is the economic and market outlook from where we are. Obviously, the market is a function of, as we all know, corporate profitability over the long time, discounted to present day. And corporate profitability is a function of the economy. And as of today, the economy in the near to medium term at least is a function of how the coronavirus or COVID situation develops, not only in India, but around the world. Let me start with a few caveats, which are very obvious and at the risk of repeating what you might have heard numerous times already. But I still think worth repeating is that we are in a very unprecedented situation. In the last 100 years, there is no example of something like that. And so there's no living human being with any background of this, living background of this. There is a level of uncertainty that none of us have experienced. And the potential scenarios are very unknown, some known possibilities and some unknown possibilities. So in this kind of a situation, it would be very foolish or naive, I would add, of not just myself, but anybody, to be very confident of how things would develop here. We can conjecture at best and think of different scenarios. It's just like, when you flip a coin in some ways, it can be either heads or tails. You can't be highly confident in such an uncertain outcome scenario of it being either heads or tails. With COVID, in fact, the situation is so there are many more than just two outcomes. So we'll talk about a few scenarios, but important to keep in mind that things can develop in a manner that none of us can envisage right now. Just 2-3 months ago, when the situation was worsening in China, nobody could have thought that as of today, India is likely to exceed the number of reported cases in China. So with all those caveats, let me try to frame the discussion in around 3 scenarios: best case, worst case, and what we might consider base case scenario. These would have far-reaching impact on the economy, and hence on corporate world and market in turn. The best case scenario is to have an effective medicine become widely available in short period of time over the next few weeks, if you will. Something like a hydroxychloroquine, which Trump did announce as effective, but turned out not to be the case. But if some such thing which is widely available becomes effective, then people and governments around the world would lift the lockdowns and economy would become normal again. Yes, people would be infected, but they would be treated. And to me, an effective medicine is something that would reduce the mortality rate to 10% or lower of whatever it is right now. Hard to say what it is right now, but by most estimates is somewhere less than 1%. So if the mortality goes down below 1 in 1,000, I think that would be low enough risk for worldwide governments to lift lockdowns and return the economies to normalcy. In such scenario, the markets are going to bounce back very sharply because the economic growth, if you were to talk about India in particular, in such scenario might end up in low single digit this year, 2% or thereabouts, because the damage would largely be limited to first quarter. And the second quarter will start normalizing, and third and fourth quarter, we might see some bounce back from suppressed levels of demand and pent-up demand. Corporate earnings, which was at the start of the year expected to be 20% plus, in such scenario would end up being mid-single digits to high single digits. But market being a discounting mechanism, they would look through that onto the next year, which would be a sharp bounce from where we are today under this best case scenario. And in our assessment, market would pierce through the highs seen earlier in the year. And so if we are down 25% currently, in this scenario, markets would rally before we all can grasp it. It would rally 30 to 40%. The worst case scenario, now moving to the worst case scenario, if you will, is that there is no medicine, no vaccine ever found. There are, while a low likelihood scenario, in my view, a lower likelihood scenario than the best case situation. It is not impossible. It has some low probability because there have been viral diseases in the past where there has been no effective medicine, vaccine found. In such situation, the economy is going to continue to operate for some time under partial lockdowns. And we'll have to get used to red, green, and amber zones. When I say sometime, it would eventually have to be where there is herd immunity. Again, there is I'm no expert in this, but from all that I have read, it might take, assuming we'll do it allow it in some controlled fashion and would be able to control it to some degree, it might take 2 to 3 years to develop such herd immunity where majority of the people or thereabouts have been exposed to the virus and hence develop herd immunity. In such situation, the economy this year could be down mid-single digits, and next year can see some rebound, again in low to mid-single digits positive, and then the year after as well, similarly somewhat suppressed, and corporate earnings in this situation can be down double digits this year, can recover next year from a low level, but still be up very modestly before recovering and limping back in the years thereafter, FY23 onwards. But this, I think, is a fairly low likelihood scenario. So I'll jump over to the base case scenario, how we are thinking about that. I think over the last 2-3 months, our expectation of a medical treatment has somewhat reduced, just because nothing new or highly effective seems to be coming out of the clinical trials or other trials of existing drugs as well as now. There still remains a good possibility that we can be, a lot of results are expected later this month and early next year, and something might prove to be more effective than the remdesivir, which so far seems to be the only approved drug by US FDA. In the base case scenario, we expect medicine is not there, but a vaccine is indeed developed over the next 9 to 12 months, or 9 to call it 15 months, and becomes widely available for administration across the length and breadth of the country by the latter half, call it September end of next year, just to pick a date. Don't want to give it more specificity than we mean to, but let's say somewhere in the fourth quarter of next year, calendar next year, it is widely administered to most of the country. Now here, again, while there's no certainty, but there are more than 100 vaccines at different stages of exploration, including some in clinical trials by some of the leading pharmaceutical companies in the world, including Pfizer, Glaxo, Sanofi, and so on, as well as biotech companies and new age companies. Based on, obviously not an expert on this, but based on what experts are saying, the likelihood of a vaccine or multiple vaccines being developed seems quite reasonable. Under this scenario, especially if at least clinically it's proven over the next few months, and that is announced and approved, and then production could take many more months, but at least if it is proven to be efficacious, the markets would rally as and when that is announced to be proven. And then the economy would continue to stay under some form of partial lockdowns till such time that the vaccine is administered, which is later next year. So this year would remain a struggle for the economy, could be down again in base case -5%. And next year might recover and be up similarly 4 to 5% on a lower base, such that FY22 is same as FY20, call it in real terms. There'll be some nominal GDP growth rate due to GDP deflator. In such scenario, we believe corporate earnings growth would be down double digits this year, about 10% and next year would bounce back 10 to 15%. And from there on would be back to mid to high teens as pent-up demand comes back with normalization of the economy. In this scenario, the market, we think at present, market is obviously representing some probabilistic weighted average of these various scenarios. And if this base case were to play out, particularly when a vaccine is announced, market would recover part of the losses that it has suffered since the beginning of the year. Now, different sectors might have different impact, differential impact. And within a sector, companies might have differential impact. In our view, under the base case scenario, again, the Western world is likely to recover to normalcy, economic normalcy, faster than India. Because rapid and universal testing accompanied with technological driven surveillance and tracking is more feasible and practical to deploy in a country like US and Western Europe than it is in a country like India. First and foremost, to begin with, due to the sheer scale of resources that they can bring to bear compared to India. In such situation, we think that export-oriented sectors would likely see demand environment normalizing sooner than the domestic sectors. Similarly, sectors like, so when I say export-oriented, obviously IT is one of the leading sector in that. Pharmaceutical, both domestically and abroad, anyways, the demand hasn't been impacted much. So they continue to remain, more or less fine shape, and would be no change there. The domestic sector, the more cyclical they are in terms of either exposure to consumer cyclicals or discretionary items or industrial cyclicals, they would be hurt more by the lack of or absence of demand or demand curtailment. And also leveraged businesses. The financials, obviously the business model itself is dependent on leverage. Whenever there is uncertainty or crisis, leverage hurts and they would be under greater pressure. And any business in any industry that is weaker would be under greater stress. The stronger businesses, the leaders in each sector, would hold up better and come out stronger of this crisis, has been seen in past crises as well. And all this, by the way, is not anything new. The market prices reflect. So you have seen pharma sector holding up much better, followed by consumer staples and IT sector, and financials and consumer discretionary and automobiles are worst impacted. And that's to be expected given the nature of the crisis. So I'll pause there on the COVID and the related impact on economy and corporate sector in the markets, and maybe move on to how we do what we do over the next 10 to 15 minutes, and then open up to questions, Sankalp, if that makes sense.
Sure, perfect, Mr. Prashant.
So Vivek, if you are there, if you can bring up the slides on the slide number 7, that would be helpful. Vivek, you are on mute. Are you able to bring the slide deck?
Yeah, Prashant, in a second. Yes, Prashant.
Okay. Let me start by saying, look, we've had very strong performance over the last many years and hope to continue to deliver that going forward as well. In our view, that is underpinned by a very focused investment culture that we have on the team, which is founded on certain core pillars that I'll discuss, where the core principle or core objective is to deliver the highest return for our clients compared to anyone else in the peer. If you go on to slide 7, Vivek, what I would highlight, these 4 pillars to us are the philosophy of the team itself, process, and portfolio construction. So we have a very while we've spoken a lot about the macro and whatnot, our philosophy is always to buy great businesses at attractive values, and hence is a very bottom-up stock selection driven philosophy, implemented by a very strong, in my bias, to the best team in the industry, local experts, stock picking experts with very long years of experience and whose interests are completely aligned with client portfolios, implementing a process that has been developed and honed over the last couple of decades, at the core of which is a proprietary analytical framework that we call CLEAR framework, and I'll spend a few minutes on that. And all along, we maintain a prudent risk management approach, what we call balanced portfolio construction approach, which consciously avoids top-down bets on macro factors and ensures that performance is a function of stock picking. So if we go quickly to the next slide, which is on the team, couple of points I would highlight. It is the most well-resourced team in the industry, particularly when compared to boutique firms in our view, with 12 people on the team at an average experience of 14 years, senior seasoned investors having experience of over 17 years. But two unique attributes I would stress on is one, it's a team that is very broad in terms of and deep. Not only the number of players, but there are many people here on the team who've seen many cycles in the past. So not just myself, but others on the team have been through Harshad Mehta scam time period and the crisis that followed, the dot-com bubble, the Lehman Brothers crisis, and now the crisis that we are seeing here. So there is an element of pattern recognition and experience that comes to bear, having lived through such situations or similar situations in terms of the market correction and crisis several times in the past. Second aspect that I would highlight, which is even more unique, is many of us on the team have experience investing globally, not just in India, and many years of experience. I, for one, as highlighted, started my career in the US, managing international developed markets equity, and then was a senior fund manager and co-chair of investment committee for several years, managing US equities before moving to India to start the asset management business for Goldman, which I ran from 2006 to 2017. And along the way was also CIO of Global Emerging Markets, where I invested in nearly 30 countries from Korea to Mexico. And the other individuals on the team as well, several of them who have invested well beyond India, including Latin America, Africa, rest of Asia, as well as Europe. That brings a unique perspective that is very helpful because many of the investment opportunities that we see in India, like insurance, for example, is a sunrise sector in India. Whereas insurance companies have been around in the Western world or even in emerging markets for decades. So having covered them and invested in them over the last 20 years brings a certain experience and pattern recognition capability to the team that is very, makes it uniquely equipped to investing in many of these companies. Moving on to the philosophy of the team, it is that outsized returns are earned over time by investing in great businesses at attractive valuation. So the two key elements are great business and attractive valuation. Now, a lot of you may be thinking that everyone says the same thing. That is true. There is no magic bullet to investing, but the devil lies in details, which we are all now realizing in relation to the big fiscal stimulus. We are all learning that the devil is in details. So what we do, what we look at is what I will share with you. What we consider as great business is one that has these attributes: superior returns on incremental capital, scalable, and well managed. These are born out of the fundamental value equation, which is that value is equal to cash flow divided by R minus G. To generate cash flow, it's a prerequisite to have returns on incremental future capital that is higher than cost of capital. For any business that is true, and I'm sure people on the call would be very well able to relate to that. If you can't cover your cost of capital on incremental capital basis, there is no sustainable cash flow generation, and hence there's no real value to the business. Scalability is all about the sustainable growth, or G, in the denominator, in the value equation that I talked about. We look for businesses that have the potential to multiply and be a lot larger in scale relative to their peers in the industry or corporate world in general over the coming years and business cycles. When you have the potential for cash flow generation and scalability, you need management that can execute and an organization with an execution DNA to capture that opportunity. Because a lot of companies, a lot of businesses have the same opportunity. As an example, in banking sector, several licenses were given in mid-90s. Some of those banks have grown and created franchises that are worth lakhs of crores of rupees today. At the same time, many others went bankrupt along the way, including one that went under or was bailed out just earlier this year. But in in over the last couple of decades. Many of you might have forgotten, but we've had other cases like GTB, Centurion, Bank of Rajasthan, and so on, which in one form or another had to be bailed out. So to assess the execution DNA of an organization is very critical, and that's what the team does extremely well. But first and foremost, it is important to understand and assess the governance DNA of the management and the organization. Because if all the other attributes are present, but governance is not, then it may be a great business, but only for the controlling shareholder, not for us minority shareholders. Because in such a case, the cash flows generated might get diverted for the benefit of few controlling shareholders. And there is no sanctity then to the equation that we talked about, the value equation that we talked about. And the best way to make money in such case is to stay away from such companies. And this is the only, governance is pretty much the only screen that we use. It's a subjective screen, but it's one that our team has applied extremely well, not just over, and particularly I would say over the last 3 years, when there were so many governance disasters in 2018, 19, and continue to right now. And the team has largely managed to avoid every one of those disasters. And that plays an important role, because the returns you generate for clients is total of sum total of where you make money and where you lose money. So if you can avoid the disasters, then the returns obviously can be. When all these attributes are present, it's very critical then to buy at a time and at a value that provides substantial upside to fair value. Because if you pay a fair price or above fair price, then you might end up owning a great company, but not making great returns. There are many who say that if you find a company like this, you can buy at almost any price, and that would outperform the market over time. Now, that may be true that such companies or a portfolio of such companies can outperform over time. But for our team, the goal is not to outperform the market, but goal is to outperform the best outperformer out there in the market. And when you want to generate returns that are substantially higher, not just modestly above the benchmark, but substantially higher, valuation plays a very critical role to make those outsized returns. And so when it comes to valuation, we have our own unique framework called Clear Framework. We don't look at E multiples or EBITDA multiples at all. We may evaluate a company, own it for years, and eventually sell out without ever talking or mentioning PE multiple on the team. What we do focus on is what we consider intrinsic or DCF value, and what we consider cash flow multiple, viewed from the perspective of our Clear Framework. The way it works is analytically, any company, call it ABC, can be split into two subsidiaries, FinCo and OpCo. FinCo is where we house the fixed assets like plant, machinery and all, as well as the working capital of the company. The revenue and EBITDA of the company are assigned to the OpCo. And the OpCo is deemed to pay an operating lease cost for the use of fixed assets. So think of it as leasing a car. When you lease one, you pay a lease cost, which entails a amortization over useful life, as well as a financing cost element. So that's akin to that operating lease cost here is akin to that lease cost. And then you pay a working capital financing cost for use of the working capital. After these costs are paid, and then you pay taxes to the government, what is left is what we call capital light free cash flow. It is capital light because all the capital resides in FinCo. And because it is after paying cost of capital, this reflects the excess return on invested capital in the business. And the present value of these cash flows, capital light cash flows, is the value of the OpCo and equals to the value of excess return on invested capital in the business. Whereas the value of FinCo is simply the value of invested capital. One-time invested capital, because a return on capital is equated to cost of capital, right? So think of FinCo as the value of dumb capital. If anyone puts in any company puts in 1,000 crores in plant, machinery and all, then 1,000 crores is value merely of that capital. So that's the value of dump capital, whereas value of OpCo is the value of excess return on invested capital that the management is able to generate on the back of its strong execution, leveraging the brands, the scale, the network, the technological advantages, or what you may have in the OpCo company. And we denote then the enterprise value of the company as equal to the sum total of FinCo and OpCo, which is the sum total of invested capital plus value of excess return on invested capital. We do it for every company out there in our investable universe. And at this time, we'll have over 500 companies where we would have broken down the value into these components. And this can vary quite vastly from company to company. I'll name two companies where we don't own either one of them. So Balkrishna Industries, for example, the invested capital of capital is only 20% of the value, whereas excess return represents 80% of the value. On the other hand, Apollo Tyres, the majority of the value is in IC because their excess ROIC is not that strong. So looking at any company from this prism is aligned with what I spoke on the earlier slide about looking for excess return on invested capital on a going forward basis. Now, when you equate this equation to the market determined enterprise value of a company, which is market cap plus debt, you can then rearrange the terms to arrive at the bottom row, which is what we call capital light price to free cash flow, which is equal to the market implied value of OpCo divided by the capital light free cash flow of OpCo for any given year. Now, this multiple pertains to OpCo, and you can compare this multiple across companies, not only within a sector, but across sectors as well, because this has normalized for capital intensity of the business model, as well as capital structure of the company, two of the things that P multiple fails to normalize for. And hence P multiples can be very misleading and lead to wrong conclusions and distorted conclusions, whereas capital light multiple allows for apples to apples comparison. Going to slide number 25 to just highlight how this is, what results it provides in practice. This is a snapshot of the portfolio as of end of April, sectorally and by market cap, and I'll come to that in a couple of minutes. But if you look at the lower right-hand side table showcasing the key characteristics of the portfolio, and if you focus on FY22, because FY21 is anyways a washout here, you'll see that for the Sensex, the capitalized multiple at this time is 35.5, call it 36 times, even though the PE multiple is only 19.5 or 20 times. Now, 35.5 should not sound as alarmingly high or something, because remember, it is on a cash flow basis and after paying cost of capital. Even if, and I've done this in the past for countries ranging from developed markets like US as well as emerging markets like China and others, across the world, for China, for example, the P multiple is 10 times or 11 times, but capitalized multiple is in high 30s because the return on capital is very poor in general over there. So, so one should not be just concerned about the 30s multiple, but where it is useful is when comparing investment opportunities. As an example, Nestle India is one of the key positions in the portfolio and has been since long. When we were evaluating it 2 years ago, the P multiple was 45 times compared to market P multiple at that time of around, call it say 19 and a half or so. So everyone's refrain would be that it's a great company, the best company in India, but it's trading at 125% premium. So we'll wait for a better time. Whereas how we looked at it, the capitalized multiple for Nestle was around 46, 47, which was a 33% premium, not 125% premium. And at 33% premium to Sensex, or the average company in Sensex, a company like Nestle with its franchise is a very compelling opportunity. And it also had sizable upside on the DCF. So that's how this plays a role in our valuation assessment, and valuation is very key input to our decision making. And while I'm on this slide, I'll also cover that the sectoral composition and the market cap weights. You'll see we're fairly well invested across several sectors, except for energy and utilities. In nothing top-down perspective against energy and utilities, and one can argue we missed some opportunities there. But given our team's philosophy, we just don't find any company there that stacks up to the fundamental philosophy. In terms of the market cap, we at this time are somewhat higher in large cap at about 70% and about 30% in mid and small. Generally speaking, one should expect mid and small to be in 30 to 50% range and large to be in 50 to 70% range. We are at an extreme end at this time, and that's simply because some of our mid-cap names have done very well year-to-date basis, and they have migrated from mid-cap to large-cap. So at the beginning of the year, the portfolio would have looked more like 55 to 60% in large-cap, whereas mid and small-cap would have been north of 40%. And without really making much changes, the weights have changed because of the stock performance. I'll pause there on the portfolio, on the investment approach and the portfolio composition. I've spoken for a little over half an hour, Sankalp. Should we open up to questions this time?
Mr. Prashant. So if you're ready, we'll take a few questions. The first question that we'll take is actually, in fact, you mentioned that the devil is in the detail, and you spoke that about the fiscal, the stimulus package. So a lot of people have argued that this is not really a package. This was due for a long time. And packages have been announced around the world, with countries going as high as 10% of their GDP. What is your take on it quickly, specifically on the Indian stimulus package, and how do you see that helping the stock market, A, and B, the broader economy?
Sure. And Vivek, maybe you can remove the slides at this time, and if need be, we can bring it back on. So, see, just in principle, normally speaking, I am not in favor of fiscal stimuluses, generally speaking, because there is no such thing as free lunch or free. If any government anywhere in the world is giving away money, it would have to recoup from somewhere else. And with some lag in time, next year or the year after, I'm worried always that fiscal stimulus may result in higher taxes on hardworking salaried people or hardworking entrepreneurs who are actually far better allocators of their hard-earned money than anyone else, be it government or any other government body, which hasn't really, earned it, if you will. So I'm, generally speaking, anywhere in the world, not in favor of fiscal stimulus. However, the current time in the crisis situation, there is some rationale for fiscal stimulus. And remember, also I'm of the view fiscal stimulus is just symptomatic relief. If there is any disease that one is suffering from, or any illness one is suffering from, there are certain medicines that provide symptomatic relief, like paracetamol typically provides a reduction in fever, which is symptomatic relief. And the other medicines which provide actual cure from the disease, right? Fiscal stimulus is merely, in my view, money-based fiscal stimulus is merely a symptomatic relief. But when pain is so acute, and fever is high, if you will, to continue that analogy, symptomatic relief is also essential. But it has to be administered very carefully and only to the extent required. So when this large fiscal stimulus was announced, if it was truly to be a handout of that larger magnitude, I would have been a lot more worried. However, it was clear to me, I won't say it was clear to me, but we did want to wait and see. In our view, it would not be as big effectively. And in our view, it is good that it is not a giveaway of 10% of GDP. Because in the longer term, it would end up doing more damage. Whatever has to be given should be given to the poorest sections of the society, where the pain is the most acute and there is the most acute desire or need for symptomatic relief, if you will. And from what the government has announced over the last 2-3 days, while disappointing for market at large, to us, it is not a bad thing from structural perspective. If it was indeed a 10% of GDP given away, it would have been more negative in our mind from a structural perspective. Whatever is given away is being given, as long as it stays targeted to the poorest sections. We think that is what is the appropriate thing to do.
Sure, that was a very great take on something we all cheered too much. So the next question is actually very interesting. I was just going through your sectoral allocation in the slide, and I saw there was some allocation to financials. So can you take just a couple of minutes or 5 minutes on how does the clear framework work on financials? If you can just take us through that, I think that'll be really interesting to know.
Excellent question. Excellent question. And I'll tell you, I developed the clear framework over the last many years. First, it was back of the envelope framework that I would do on companies starting from over a decade ago, and then implemented a version of it in somewhere around 2013. But never quite got to resolving the question of how to implement it on financials, banks, NBFCs and all, till very recently when I threw it as a challenge to our team here at WhiteOak to figure it out. And they did come up with a very, I would call ingenious and simple way of accounting for it. But it's too complicated, Sankal. While it is very simple, when sitting across the table with a piece of paper to explain, it is going to be quite complicated to explain in this format. But it can be done. But the question is very insightful. It was what we got to after more than a decade of using it on non-financials.
So maybe we can see WhiteOak, writing a note on it and explain us their take on it. So the next question is actually a very allocation kind of a question, allocation strategy kind of a question. So what do you think should be the portfolio position right now? Debt, equity, what kind of allocation should be there? And if you have to look at any other asset class, what should it be? So
certainly. So asking the wrong person. Vivek, I'd like you to show that slide, the long-term slide. So I'm going to use a chart, and I've lived by it. So it's not just making up something. All my life, I've been 100%, oftentimes somewhat more than 100%, rare occasions somewhat less than 100%, but more or less 100% of the liquid wealth certainly has been in equities. I show this chart, and the title of this chart is Guaranteed Real Loss versus Compounding Gains. So I consider fixed deposits or debt investment basically as guaranteed real loss almost anywhere in the world, not just in India, as against equity, which provides maybe uncertainty in the near term, but compounding gains over the long term. I've chosen the year 1985 because that's the year when I started fairly early investing in the equity market, because that was the year. That year is still the best year in Indian equity market, up 100%. Sensex was up 100%. 84 was when Indira Gandhi was assassinated. Rajiv Gandhi became PM, and market had a very strong 100% rally. So I, as a retail investor, as most retail investors get sucked in to market during rallies, and my family always was investing all its money and savings into equity market. So I got sucked in at an age of 13, if you will. And since then have been fully invested. But I know many people as my neighbors and relatives who were far better off than I had 5,000 bucks in my piggy bank. But these were people that I'm talking about at that time might have been crores or had crores of rupees invested in the market. And many of them only invested in fixed deposit. 1 crore invested in fixed deposit in 1985 today would be worth 8 crores only. I believe there'll be many people on the call who would agree that the value of 8 crores today is a small fraction of what value of 1 crore was in 1985. Inflation itself would have taken money to 12 crores or prices to 12 crores. So in real terms, people have lost wealth investing in fixed deposit. And that's not just applicable in India, but almost everywhere in the world. The interest rates settle into a kind of equilibrium where after paying taxes, people would not be able to earn inflation. Whereas someone who had invested in just some random collection of Sensex stocks, they would have earned, and this is as of start of the year, but even after the 25% fall, the 15% might have gone to 14%, right? So, but let's just use this chart that we have here. 1 crore would have multiplied at nearly 15% compounding and taken 1 crore to 115 crores over this time. And I think that would have maintained, the value of money. What today is of 100 crores is similar or higher than what value of 1 crore was back in 85. Whereas if you are able to add, and there are many people who have added 1,000 basis points of outperformance, at 25% CAGR, just to give you an example, the 1 crore would have gone to 2,200 crores. Fortunately, I recognized this math somewhere very early in life and hence have dedicated my life in the pursuit of such equity investing. And that is what the rest of our team has done as well. So you're asking the wrong person in that sense. In our view, the allocation for us is all 100%, but yes, each individual, depending on their risk appetite and in consultation with experts like yourself at PMS AIF World, should decide what is an optimal asset allocation for them. My only point that I would add is that whatever asset allocation is decided should be decided in normal times, not in such crisis situations. And that asset allocation should not be flippantly changed depending on where the market is, whether it is in crisis or in euphoria. One should, in a disciplined manner, through the vagaries of the market, stick to a disciplined allocation. And at this time, I would say when times are so uncertain, more than any other time, it's important to adhere to such an asset allocation plan that was designed at more normal times.
Sure, Mr. Prashant. The key takeaway here is you should decide your allocation during normal times and stick to it during tough times. So we'll take the next question up. So you described your team has extensive global experience, have looked at stocks across the world for a while. So how does India fare in valuations compared to the other EMs? So you won't look at the developed market now compared to other EMs like Brazil, Russia, China. What is India's, are you comfortable with India's valuation given that a lot of disruption is about to happen in India too? So obviously the other countries will do, but please do your comments on that, please.
So I've got this question for the longest of time, that India's multiple is higher than other places in the world. And I would request Vivek to bring up that slide where we show the government ownership across various countries. So India, again, P multiples can be very, misleading if you just go at with a superficial view of that. So it is true that the P multiple for India tends to, and even today, is higher than most other emerging markets. Vivek, if you can pull up that chart, that will be helpful. Slide number, yes, this slide. What we have to recognize that there are many differences in what makes up the Indian equity bucket or index compared to what makes up other emerging markets bucket. As is shown here, you'll see that in India, the weight of government-owned companies or the PSUs in the market or the benchmark is only 10%, in fact, less than 10%. Whereas other countries have much higher weight. The EM average is 25%. China, Russia, Indonesia, Poland, they have weights ranging from 40% to 67%. Now, government-owned companies have a whole host of problems that besiege them at all times, including governments. Hence, everywhere in the world, they trade at a fraction of the multiple that their comparable private sector trades at. And you don't need to look too far, just look at the financial sector in India, what the leading private banks are trading at, and what the leading government banks are trading at. In India, in the benchmark, particularly the MSCI India that global investors look at, 90% is private sector companies like HDFC, Kotak, and so on. Whereas in China, 100% of the banking sector is government owned. So they ought to trade at a fraction of what the Indian banking sector is trading at. And then if you go on and make this adjustment across the various sectors, this single factor, which is government ownership, would explain for most of the valuation differential as seen from P multiple. So if you make such very logical adjustments, most of the apparent P multiple difference would evaporate, and we are no different in terms of valuation than what other countries are. And all the countries are pegged to ultimately the benchmark, which is US 10-year bond yield. US 10-year bond yield, when I went to the US in 95 to study, was somewhere in the mid single digits, call it 5%. So if you were to look at the multiple on the bond earning, it was US 10-year bonds or long dated bonds were trading at 20 multiple. Today, the bond yields, those bond yields have gone to 1% or thereabouts, 1 to 2% call it. So those multiples have gone to 60 to 80 multiples now, right? So if that is the benchmark, the equity market multiple would also go higher. So S&P 500 in the US, which used to trade at 15 multiple in the mid 90s, when I went to the US to study, today it is at 20 multiple. So that has to be kept in context of what other asset classes have done. You can argue the bond yields are very low today and all that, but that also have to be, I mean, what is the context for that? Inflation expectations are dead today for a variety of reasons, and reasonably so, because inflation primarily driven by commodity inflation or wage pressures. Commodity inflation due to the shale oil discovery as well as the focus on renewables. Fossil fuel inflation, reasonable to expect, is dead for many decades to come. And with all the advances in artificial intelligence and autonomous driving and whatnot and the drone technology, what we are seeing in US, despite historically low unemployment rates, wage pressures have been de minimis. And hence wage inflation also de minimis. So when inflation pressures are close to zero, and many countries in the developed world fighting to spur some inflation. Japan has been trying it for years, and now some of the European countries are trying as well, rather than keeping inflation down. In such scenarios, it's only reasonable to expect that over extended periods of time, bond yields would remain very low, and hence bond multiples would remain very high, and hence equity multiples would be higher. Now, if inflation expectations were to change suddenly for whatever reason, then there would be risk to multiples. But absent that, the multiples, have a rational basis to them.
Thank you. That was very insightful, and I am really, and I'm sure that a lot of investors saw this perspective of the valuation for the first time. So we'll take the last question, and it's a little off market, but it's a very important question for everybody listening on this call and for people who run businesses. In a fair bit of time, around 3 years, you have managed to raise around $1.7 billion in assets. So please tell us what how you went about that, your success story at WhiteOak, please.
Thanks a lot, Sankalp, for the compliment implicit in that question. I would say it's not as easy as it appears. While WhiteOak as a company has been for just 3 years, obviously, and myself have worked for 22 years in the industry of professionally managing money. And we have a very, very strong and seasoned investment team, which collectively has spent nearly 200 years professionally in the industry. And so when clients are entrusting us with their capital, it is the confidence in the team and the team's experience and the team's accomplishments historically or longer term as well. As for example, the funds I have managed over the last 13 years have delivered top 1 percentile performance, including the 3 years here at WhiteOak. Team has delivered performance that is ballpark in top 1 percentile, despite a very challenging time where very many managers have struggled to keep up with the benchmark. While it seems like 3 years, it's really a lot of effort and long gestation behind it. And one other thing I'll quickly add is what I was very pleasantly surprised from a client's perspective is that many clients who for many years had interacted with me when I was at my prior firms, large firms I've been working at, but they never gave money over there. But as soon as we started this boutique firm, I was pleasantly surprised to see how many of those clients who had otherwise followed me for 8 to 10 years but not given money came forward to give money, because globally, these sovereign wealth funds and pension plans and family offices have a strong preference for boutique firms compared to the larger organizations, because they believe at boutique firms, the interests are more closely aligned to client portfolios, and the focus and enthusiasm for generating returns is of a different level altogether.
Thank you. Thank you, Mr. Prashant. Thank you, Team WhiteOak, for being with us today. Thank you, audience, for being with us today.
Thank you, Sankalp. And thanks everyone for joining and sharing the evening with us. I hope it was worth your while.
Sure. Thank you, sir. So to the audience, you can always visit our website, www.pmsaifworld.com, to know more about the WhiteOak portfolio. You can also give us a shout and we will get back to you. Thank you, Team WhiteOak. Thank you.
Thanks
audience.
again, Sankalp. Thank you.